Howdy, Jacob here. Today we're going to do a more in-depth review on the company Medifast, ticker symbol MED. Just a reminder, this is the goal of this video is to be reviewed in conjunction with your own analysis, and everything I say will be of my opinion. Say what you want about it. Now let's look at the business. Okay, so reminder, we're going through financials and then we'll get into some of the specifics that I reviewed during their quarterly report and 10Ks, 10Qs and such. And so currently $593 million market cap on $435 million enterprise value. So their net debt is actually negative, meaning they have more cash on hand than debt. Their margins are relatively flat from 10 years ago. Looks like they did pay a dividend for 8 years and it grew very substantially. They're 6.56%, $6.56 dividend per share would be the equivalent of about 12% if continued now. And they canceled it. So if you're looking for a dividend stock, just stop the video now, and this isn't going to be the company for you. But I'm still going to do a further review on the company to see if it makes sense from getting the 15% return that we're looking for from a conservative perspective. And so, other notes of the business is that this year in July, they added lines of exercise supplements and protein powders, which obviously increases their addressable market cap. So, that's great for them. We see that their payout was roughly 70% of their 5-year average free cash flow and dividend. And so that 12% dividend yield, only paying out 70% on a 5-year average basis. Not bad. Meaning they have a lot of cash in comparison to they have a lot of cash flow in comparison to their current market cap right now. People must be, very worried about, what's ahead of them. I know unknown is tough for investors, and so, but the thing about unknown is it could create opportunities. So always keep that in mind. There's a reason that public companies get undervalued a lot easier than private equities, um, private firms. So they have an interesting approach to health and wellness, where roughly 90% of their coaches actually started off as customers. And so their coaches are contracted by Medifast, and they help their customers they coach their customers through whatever they need to. But I found that interesting that 90% of coaches that helped their customers as contractors were actually customers themselves. So that's kind of cool. They have zero interest bearing debt. So I wanted to show you this. This is very positive scene is that their liabilities just include a little bit of lease obligations, accounts payable, income tax payable, and then current lease obligations. They have no long-term, short-term interest-bearing debt, just their lease obligations, which will have interest. But a lot of cash on hand in comparison to all of that. Well, in comparison to zero, everything seems like a lot. So 157 roughly $1 million in cash equivalents and investments. So that's a very healthy balance sheet. Unless you're looking at net, the balance sheet doesn't necessarily give you value, but it does tell you how safe or risky an investment can be, obviously in relation to price. And so that's something I wanted to know. They have more cash-like assets than total liabilities, so that's kind of cool. So 157 million in cash equivalents and investments, and 126 million in all of their liabilities. So definitely a safe balance sheet. I think we can all agree that. Margins are, like I said, relatively flat, maybe slightly improved, but in the most recent year to date, 2023 versus 2022, we see that revenue is down roughly 30%. So a massive hit to their revenue recently, which I guess would make sense why they cut the dividend to try to focus on growth. Maybe that's not the smartest move. Sometimes you got to know when to quit and whatnot. But I think with the cash on hand in relation to their market cap, I think they do have a decent potential to maybe down the road get back to the growth numbers that they were producing beforehand. I mean, if we look at 2016 to 2022, they had 275 million revenue in 2016 up to 1.6 billion in 2022, and that was made with very little acquisitions. And so that was very, very much just internal growth of the business, which is always good to see, since acquisitions can sometimes get a little sticky and affect margins, and you overpay most of the time, it gets a little tough. But natural growth is always a good thing to see for a business. But that 30% decline in revenue is an absolute terrible case that you definitely don't want to be seeing. Um, and we see that their dividend was suspended. I already said that, to focus on growth initiatives and stock repurchases. So because they don't have debt, their use of capital allocation is down to four. They can either reinvest in themselves, make acquisitions, uh, repurchase shares, or pay a dividend. And they're not paying a dividend, so um, it's really just reinvesting, making acquisitions, and paying down some of that stock, uh, or having stock repurchases. I don't know why that was so difficult for me to say, but they've already said that they have two growth, uh, two uses of their free cash flow: growth and stock repurchases. Their initial review of share repurchases is poor capital allocation. So that's another thing that is a negative for the company. We see in Q1 of 2021, they bought back almost 37,000 shares at $251. And now we're seeing the price under $100, and they bought back less than 2,000 shares in the most recent 2 quarters. And so you want companies to be buying back absolutely, obviously cheap prices to where they can't get that return elsewhere. And so that's a big negative. They invested a lot of money in a stock that, the stock price is way higher than it is now. Again, I already made a video about this. What happens in the short term isn't necessarily right or wrong. But to me, I think if you're buying back as many shares as they were above 200, and I'm going to do my price evaluation right now, 200 seems like a fairly expensive price. And so I think that was a poor use of cash when they could have, done better investments with it, especially in the fact that their return on invested capital is as great as it is. So if they were to have, find ways to use that cash to grow the business, they likely would have had a way better chance of getting a better return than just buying back shares that, to me, were over $200 is expensive, would have been expensive, especially at that time. So another note is that they have 1.3 million shares eligible for repurchase as of this moment. Their market cap is under $1 billion, and when it's under $1 billion, I like to see a lot of insider ownership, and I do not see that here. So that's another negative for the company. Just 2.13% held by insiders. When insiders own the business, they likely do better things, more in line with the the shareholder. And so when it's less, it's not to say that's bad necessarily, but just you like to see a smaller company has a lot more insider ownership, so that they absolutely do what's best for the business. And then just recently, they entered into an agreement with LifeMD to not only have a coach for their clients, but also a board certified clinician. And then I did a quick review on LifeMD. They have a lot of insight since they invested $10 million of buying the stock, and then also $10 million to support the business. And so the business itself, 20.3% held by insiders. It's great. They're probably doing what's best for them. $235 million market cap. They offer telemedicine, lab, pharmacy services, and specialized treatment across 200 conditions. And under the terms of agreement, Medifast will utilize LifeMD's virtual care technology platform to provide Octavia clients access to a clinically supported weight management program, including GLP-1 medications. And so there looks like they're going beyond their scope of um, what they do, which is have a health plan with food and diet and workouts, and actually incorporate a clinician to help with their medication as well. So that's what they're looking to grow at. To me, with my new assumptions, again, they don't have a dividend, but with my new assumptions, really the only change I had was just to expand my margin from 7% to 10% on the earnings and free cash flow, to say if their growth opportunities actually don't work, it's going to go to 7, and it's pretty close to today. So um, just do your own research and hope you have a great rest of your day. Thank you.